Okay, so we'll start with IRR, the part that was left in the last class. So before we going to discuss IRR, internal rate of return, let's have a quick review of what was discussed in the last class. Well, this chapter, capital investment decisions. Well, in this chapter, we discussed several methodologies to help managers to make future business decisions regarding capital investment. Well, four methodologies are discussed in this chapter. The first and the second methodology are payback and ARR, that is accounting rate of return. Well, these two methods do not take time value of money into account. Also, we learned another two methods that takes time value of money into account. They are NPV and this one, IRR. Well, in the last class, we discussed about time value of money. We know that $1 today is more worthy than $1 in the future. Well, that is basically how NPV, net present value, works. Well, briefly, net present value is a comparison between the present value of this investment and the initial investment. If the present value of the investment is greater than the initial investment, we would think, well, this company can invest, otherwise cannot. Regarding time value of money, we know for calculation, we need three factors. First, the principal amount. Second, the number of periods. Third, the interest rate. Well, to calculate net present value, we know what the interest rate is, how many periods we have, that is the lifespan of the investment, and also we have the estimate of the return of this investment in each year in its future lifespan. Okay, so what is IRR? IRR is basically the rate of return on discounted cash flow of a capital investment. Or in other words, IRR is the interest rate that makes the NPV of the investment equal to 0. So I believe you guys now are able to use the interest rate table. Yes, this one. This is the interest rate table to calculate the present value. We have different periods and different interest rates. Well, by referring the corresponding column with the interest rate, and we can find the present value factor in its corresponding periods. Well, as I said, IRR is the interest rate that makes NPV equals to 0. Well, in calculating the NPV value, before the calculation, we have known what the interest rate is. But here, we do not know the interest rate. And the interest rate here is the IRR of this project or this investment. Well, let's take a look at an example. Well, if you can remember Smartest Learning's laptop project, this project would cost $1 million with 5 equal yearly cash inflow of 305,450 each year. To know this investment's internal rate of return, we look at this formula. First of all, we need to know its annuity present value factor. It can be calculated using initial investment divided by amount of each period's cash inflow. So that is 3.274. Well, we know the present value factor is this, and we also know number of periods, right? 5 periods. So the question is how much the interest rate is. To know the interest rate, well, we look at this table. The second table, annuity present value factor. Okay, we look at this table. We choose the column with the number closest to the annual present value factor in 5 years row. We know the period is 5 years. So from 5 years row, we choose the number closest to annuity present value factor. Well, our factor is 3.274. So right here, 3.274. That is the annuity present value factor with 5 years periods and the interest rate to be 16%. So right here from this table, we know the IRR for laptop projects is 16%. Well, this company expects the project to earn an internal rate of return of 16% over its life. We can confirm this result by using a 16% discount rate to calculate this project's NPV and prove the amount is 0. In other words, 16% is the discount rate that makes the investment cost equal to the present value of the investment's net cash inflow. So if you can recall from the previous part that the company Smart Touch Learning required a minimum rate of return to be 14%. And from this calculation, we know that the company's internal rate of return is 16%. So our decision is to accept this investment. So here is a summary. If the IRR meets or exceeds the required rate of return, we invest in this project. Otherwise, we do not invest in this project. Well, in laptop project, the exact annuity present value factor appears in present value of an ordinary annuity of $1 table, but many times the exact factor will not appear in the table. For example, if we find the IRR of the Smartest Learning's B2B portal project, if you can remember that for B2B project, well, the initial investment is 240,000 and the amount of each cash inflow is 60,000. So the result in this calculation is 4, exact 4. And in that project, the number of periods is 6. So if we go back to this table, well, the number of periods is 6. And in this row, we cannot find the interest rate, the annuity present value factor to be exact 4. So the only thing you know is the closest value. The closest two factors are 14%. At 14%, 3.889, and the value at 12%, 4.111. So we can tell that this project's IRR must be somewhere between 12% and 14%. Well, if you need to know the precise figure, we can use a business calculator or Microsoft Excel to arrive at the exact figure. Well, later in this part, the later part of this class, I will show you how to use Excel to do this. Well, this is the calculation about IRR with equal periodic net cash inflow. So next, let's take a look at the calculation of IRR with unequal periodic net cash flow. Well, to calculate the IRR with unequal periodic net cash inflow, we must use a trial and error procedures to determine the discount rate, making a project's NPV equal to 0. Well, for example, because the company's minimum required rate of return is 14%. Smartest learning might start by calculating whether the desktop project earns at least 14%. If you can recall from the NPV calculation, that's the desktop project NPV using a 14% discount rate is, well, 78,910, because the NPV is positive. The IRR must be higher than 14%. So the company continues trial and error process using higher discount rates until the company finds the rate that brings the NPV to 0. So this table shows the NPV calculation using the discount rate of 16% and 18%. Well, if we increase the interest rates to 18%, the NPV is 3,980, which is slightly close to 0. So the IRR of these projects must be slightly higher than 18%. Well, this is the calculation of IRR with equal or unequal periodic net cash flow. But to know the exact amount, it is a better procedure to use a business calculator or Excel. Well, this is the summary of 4 different methods regarding capital investment analysis: payback, accounting rate of return, net present value, and IRR. So sensitivity analysis, if you can remember from the previous chapter, sensitivity analysis is a what-if technique that shows how the results differ when underlying assumptions changes. So to do this, it is better, as I said, to use Excel. So now I will use this example to show you how IRR and NPV is calculated using Excel. Now we can start making this spreadsheet. It's smart touch learning companies capital investment analysis. We have two projects. Let me make it wider. Two projects, laptops and desktops. Well, here I need to make the title center across selection. We right click those cells, go to alignment and choose center across selection. And also I need to make laptops and desktops underlined. To add a bottom border. Well, also this cell to be bold. I need the inputs, two inputs. Useful life in years and discount rate. Well, useful life is basically the number of periods to be 5 years and discount rate to be 14%. We have some constant. Initial investment to be negative 1 million. Make it wider, this column wider. And also, same initial investment to desktop project. And next is the estimated cash inflows. We have different years. Year 1, year 2. We have year 3, 4, and 5. Okay. For laptop project, I need to center these two cells and also make it bold. For the first year, for laptop project, same amount of cash inflow for the future 5 years. That is 305,450. Well, for desktop projects, this amount differs in each year. For the first year, 500,000. Second year, 350,000. Third year, 300,000. Fourth year, 250,000. For the last year, 40,000. Okay. We also need a total row. Well, we need to make the last year cash inflow with a bottom border and make the total row a bottom double border. Well, now the display in this area is regular numbers. But to make it looks more professional, we need to make it accounting numbers. We click here, accounting number format. To format this area as dollars amount. Well, this is an error sign. It means this column is not wide enough to display all the information in this cell. Well, we can double click this area to make it wide enough. Double click. Good. And double click this area. Okay. Well, to calculate the totals, well, we do not use a calculator on our cell phone or to calculate the total number manually. Instead, we use a function in Excel. So that is sum function. So to sum all numbers in this area from B12 to B16. Well, that is the sum of this cash inflow in the 5 years of laptop projects. And also, we use the same function to calculate the totals for desktop projects. Okay, now we have the inputs. 3 parts of the inputs: the interest rate, the periods, and the annuity amount. cash inflow for each year of this investment's lifespan. 3 factors. So next, I need to know the outputs. The outputs should be NPV and IRR. Well, before I introduce the financial functions, I need to tell you something about the basic layout of the Excel spreadsheet. One method of setting up this spreadsheet is to have the areas of the spreadsheet designated for inputs and outputs. So in this example, this area is the inputs, and this area displays the outputs. So in the inputs area, we can change different assumptions. For example, we can change the useful life to be from 5 years to 6 years or 7 years or other time periods. And also, in the inputs area, we can change the discount rate from 14% to any other interest rate. To calculate the outputs, we need to use some financial functions. Well, but what is a function? So basically, the function is a black box. You give this black box an input, and the function gives you an output. You do not know what happens inside the black box. Well, for example, in this cell, we use the function, SUM function, sum function. We know this function is used to add the numbers, and the output is the sum of different numbers. Well, regarding a formula or a function in Excel, there are various kinds of inputs. So actually, NPV is a function in Excel. But let's look at the required inputs of this function. To insert a function, you click this icon and find the function that you need. Here we need NPV function. Yes, right here. Well, you can see this function requires two inputs. The part that is both means, well, this input is required. So the first input is rate, or the interest rate. Well, the interest rate is listed in B8. So we can click B8 to tell Excel, well, the number in the cell B8 is the input of interest rate, and value is the, well, in this example, this value must be the estimated cash inflow in each different period. So this data can be found from B12 to B16. Well, as you know from the previous part, three factors are needed to calculate the NPV. Well, here we have know the interest rate, and we also know the cash inflow for each year. And one more thing, the number of periods. Well, actually, the number of periods can be automatically calculated by counting the numbers of cash inflow, the number of sales that shows the cash inflow. That is cell B12 to cell 16. Within this area, we know 5 cells are counted. So this is how to use NPV function. And we click OK. Well, this is not how we calculate NPV, because this is just the present value of your investments. We also need to compare this amount with initial investment. So we also need to subtract this number, the number in B10, and click Enter button. Oh, not subtract, but plus this amount, because the number in B8 is already a negative value. Okay, this is how you calculate NPV for laptop project. We need to do it in desktop project. So the only thing you need to do is to copy this formula in B20 all the way to D20 and delete C20. Okay. If we double click this cell, we can see the formula is copied from B20 to D20. Well, this is NPV function. We also need to use IRR function to calculate the exact IRR value for each different investment. So we click Insert Function button and find IRR. Right here. Well, in this function, only one value is required. That is the expected cash inflow for each year, for each period. For laptop products, that is this area, from B12 to B16. So that's it. And we click OK. Not B12, B10. We need to include the initial investment. Okay, this is 16%, and we copy this cell, the formula in this cell, to D21, and click and delete C21. Well, we know the internal rate of return of desktop projects is 18%. Well, but as we discussed, it should be an amount slightly higher than 18%. You need to know how much higher. So from this window, format cells, we can change decimal places. By default, it is rounded to the nearest dollar. And we need to change this to like 3 decimal places. And click OK. So that amount is rounded to be 18.235%. And also, as you can see, this amount, the IRR for laptop products, also changes by different rounding criteria. Okay, this is how we calculate the NPV and IRR value using Microsoft Excel. So this is the end of this class. All right, and do you have any other questions?